Hello everyone. Today in our video we will discuss weighted average cost of capital, and you know that the weighted average cost of capital is basically calculate a company's cost of capital where each category of capital like equity, debt is proportionally weighted. So it represents the minimum return that a company needs to earn on its existing assets to satisfy its investors, creditors, and owners. So this is basically used to optimize the capital structure of a company, like from which sources they should collect the fund. So the formula of weighted average cost of capital is basically the sum of the three components. You can see there are like uh, this one is the first component, and then second and the third. So the first component is the debt component, and the equity component, and the preferred stock component. So for the debt component, we need to find out how much weight we should put in the weight. So in the debt, so WD represent the percentage of debt, and RD represent the cost of debt. So for each component, we have to multiply the cost of that particular component, and you can see like weight of debt and the cost of debt, and there is a weight of equity and the cost of equity, weighted of preferred stock, and the cost of preferred stock equity. So the only differences in case of cost of debt, there is a tax shield for the debt. The reason behind this is the tax rate is applied to the cost of debt in the WACC formula, because the interest on debt is tax deductible. That means that a company can deduct its interest expenses from its taxable income, which ultimately reduce the overall cost of debt financing. So this tax benefit is also known as the interest tax shield. So you ha you have to apply this tax shield when you calculate the cost of debt. So let's look at an example, so it would be more clear. Uh, so if you have the value for debt, weight, the cost of debt, weight of equity, and the cost of equity, weight of preferred stock, and the cost of preferred stock, you just plug the values in the formula. And this is just an hypothetical example. So if say like there is a 40% of the debt, which carries like 6% of cost of debt, and there is a 30% tax rate, so you get the tax shield, you adjust that amount, so you just plug the value and you got your weighted average cost of capital, which is 8.48 8.48%. So you can also identify the three components of the cost. Like if you want to know how much is the debt component, you just find out the first component of the formula, and if you want to the equity component and the preferred stock component. So the main intuition is you have to figure out like how much weight you want to put in each source, and find the cost of rate for that source, and you can just multiply that and you get the expected value for that debt component or equity or preferred stock. And if you multiply it, if you add all these components, and then you can get the weighted average cost of capital. So how we can interpret these results for weighted average cost of capital, like 8.48%. So for 8.4%, this means that minimum average return that the company must generate from its operations to satisfy all its capital providers like debt holders, equity holders, and preferred stockholders. So if the company earns more than this rate, it creates value for its investors. If it earns less, it may be like eroding the shareholder value. So does you know like how to calculate the weighted average cost of capital? I hope this video helps you to understand the concept of weighted average cost of capital. So if still you have any question or any concern, just feel free to reach me. uh, Thank you.